Let's get over to Geoff Lewis. Well, don't have to get over to him. He's right here. He's from JPMorgan Asset Management. Geoff, thanks for coming in. The world economy is a dangerous place with recession and distinct possibility thanks to turbulence in the Eurozone. Now, that's the same story as last year.
It's the same story. It's a repeat, but we are further down the road, and I would say that there's one important difference.
Is there a can still there?
Oh, there are plenty of cans, I think, but these metaphors are maybe getting a little bit tired. The one thing that's really different now is the US is moving away from recession. That's quite clear. We've had better data.
But is it really? Okay, the data has been good, but people would say, does it have the momentum? And given the amount of stimulus the economy's had, you know, you'd be amazed if it wasn't showing some signs of life.
That's fair enough. If you had to put it in like scenarios, I think high conviction is still muddling through, deserves 70%, and that would be low, fairly disappointing growth at 1.5 to 2%, but not a double dip. And importantly, the US not fallen into recession. So that is not such a bad environment for equities, given that they've derated in the US. Earnings growth has come in at, what, 12% last year? And so equities are actually cheaper on that score. So things like recession indicators, the Chicago Fed National Activity Index, is moving away from the danger level. So it's disappointing sluggish growth still, but at least the US is not in the muddle that Europe's in.
Okay, so does that mean you stay out of Europe? Because, you know, it doesn't seem like there's a good place to be parking your money anyway. And, you know, I'm just talking about equities for the time being.
Yes, I think it is not really the time to jump in and go massively overweight Europe, because Europe has real problems. The policymakers have not got on top of that, so I think we can expect a lot further volatility. A lot of bad news is priced in now, in that there's an expectation of a mild recession in Europe of, say, -1 to -0.5% for the Eurozone GDP growth in 2012. But there's a distinct possibility of something worse if the Eurozone policymakers continue to make a hash of things.
Well, are there? I mean, do we see any? I mean, we recognise that they are recognising that there needs to be some sort of fiscal discipline in the Eurozone, but there always was, but it was just never really, well, how can I say, properly instituted.
That's right, but I think what investors are querying is if they didn't hold to the original Stability and Growth Pact, and that includes the core countries like Germany and France, what's the guarantee that they will do so again? And these longer-term fiscal issues surely are a long way from the market crisis and the contagion worries that we're seeing now. They need to address that. The long-term things, okay, there's some problems, but there's a big short-term problem which the policymakers seem to have no idea how to address, and that's the issue for us, I think.
I'm going to talk about Asia now. I'm just going to start off with a look at Japan very briefly here. People sitting there at the start of every year, they always get one or two going, Japan. This is the year when the Nikkei comes back, right? Okay, and these predictions have proved to be absolutely, well, futile in previous years, but you are overweight Japan.
That's right. I think that's maybe a bit of a contrarian call. I think it's based on valuations, based on the fact that Japan, of course, was knocked off course last year by the earthquake, tsunami disaster. There's been a bit of a cyclical rebound. It's more of a tactical call. It's not that we're becoming very positive on Japan from a strategic or long-term point of view. It's still got a lot of problems. It's still pretty much post-growth.
So overweight Japan, but underweight Australia.
Well, we're not that positive on commodities for 2012. Surely, on a long-term basis, yes, still, and for diversification purposes. But I think we're seeing that perhaps there's a bit of a hedge to China hard landing.
Geoff, very quickly, favourite market?
Favourite, definitely the emerging markets. That's where the growth is.
Namely?
Namely Brazil, Turkey, China, India, Indonesia.
Even India, given the fact that the economy there is having some serious headwinds.
It has some serious headwinds, but I think a lot of that bad news is priced in. It's probably a bit early to go aggressively overweight, but for a longer-term investor, investors are not losing faith with India as a long-term structural growth story. So at some point it will start to improve, maybe not for a couple of quarters.
Geoff, great having you on the programme as ever. Geoff Lewis from JPMorgan Asset Management.